Thanks very much. Thanks to the Bank of Lithuania for organizing this conference on a topic that is very interesting and high on the agenda of all of us, I guess. So for this topic, the topic of the session is current macroprudential toolkit. Does it allow for effective targeting of real estate imbalances? So for this topic, I will adopt a policy perspective and present you a few case studies. So the usual disclaimer applies. These are my views and not necessarily those of the Banque de France. The outline of the presentation will be the following. I will talk about real estate market imbalances and the macroprudential toolkit. But these two items, as they've already been covered by other speakers, and I guess that they're well known by most of you, I will go rather quickly and then dedicate a little bit more time to the policy perspective and the case studies. So first item, which indicators can we use to detect real estate market imbalances? So it has already been said, we have indicators about prices, and the most common view is that we try to assess overvaluation of real estate prices, so price level, price growth. We have ratios such as price-to-income ratio, obviously, or compare also real estate prices with other prices from the goods market, for example. Then we have also indicators about the return. So is the profitability of real estate lower or higher than what it was previously or when we compare it to its long-term average? So it depends on whether you target residential or commercial real estate. Then also, obviously, indicators about the volumes of transactions, construction activity. A very high important one that was already mentioned by previous speakers is the household indebtedness. Obviously, credit standards, LTV ratios, DTI, DSTI ratios, and last but not least, the importance of real estate for lenders, in this case for banks, when we compare it, the credit for real estate compared to banks' capital ratios. So what we have to keep in mind is that we have also to be cautious in interpreting these indicators. That was also be said by previous speakers. One of the main reasons is that real estate markets are very heterogeneous between countries, obviously, but also inside a given country. So when you use very aggregated indicators, this may totally mask or hide the dynamics between cities or regions. And there's also the question of the responsiveness of the supply good tax policy, the way housing is financed, also obviously the question of land availability, etc. So let me now turn to the macroprudential toolkit. So again, this is well known, I guess, for most of you, so I will go quickly and not spend too much time on the pros and cons, but present you very briefly about what we have in Europe and in France also. So the first kind of measure, the first type of capital requirements, which we find in the CRD, CRR. So in this case, risk weights or minimum LGDs, which is another way of setting risk weights for IRB banks. We also have, obviously, Pillar 2, even though this is more a microprudential measure and it's not specifically defined for real estate risk, as we know. We have capital buffers, such as countercyclical capital buffer or systemic risk buffer. So these are broad measures that do not target real estate, but they can also be used in case we think real estate vulnerabilities are part of a broader systemic buildup of systemic risk. And then we move to measures that have currently no EU legal basis, but have a national basis. So LTV caps, for example, which have a legal basis in France, in my country, and apply to all lenders, not only banks. And DTI, DSTI, and LTI caps, which also here have a legal basis in France. just to say very quickly something about the effectiveness of tools. So this was already also presented, I guess, by Erlan in his slides. So to put it very simply, we have something about limiting credit growth, and in this case, borrower-based tools such as LTV, DSTI seem effective. So you have a number of studies that show this. More precisely, Kuttner and Shim show that DSTI caps seem even more effective than LTV caps. Then there's the question of when are they effective? And it seems that they're effective when they are tightened and when house prices are high. This is from McDonald 2015. Then we have something about the comparison of the measures. So borrower-based measures on the one hand and capital requirement on the other hand. And it seems that quantity-based measures or borrower-based measures seem more effective in curbing bank credit growth than capital requirements. And then we reach the question of prices and real estate prices. And here I have to say that there's no clear consensus about are they effective to curb real estate prices. So, for example, Kuttner and Shim think that none of these measures seem to have a significant impact on real estate prices, while others think that they can influence price dynamics. So there's no consensus here. And last but not least, the question of non-banks. And this was from a paper from Cesar and Al, from our Dutch colleagues, say that the issue is that when you apply measures only to bank lenders, then they may be circumvented by non-bank lending, and that's an issue that they're facing in the Netherlands. So then the necessity of extending the current toolkit to also non-bank lenders. Now, let me turn to the main point of my presentation, the case studies. So before presenting them, I just want to say a word about the framework or the general approach that we follow when assessing these case studies. First of all, we do a risk assessment to detect the risk and then try to assess it. So what are the exposures? What is the probability of materialization? And then we also try to quantify it more precisely, for example, through stress tests, to get at least an order of magnitude of what level the risk we are facing. In case we think we are facing a risk of a systemic nature, then there's the question of the policy action, and more precisely the question of macroprudential policy action. Because as was also said by other speakers, sometimes macroprudential policy may not be the best policies to use. So in case we want to use macroprudential policy, there's the question of which measures do we use, when do we activate them, and to what level. So selection, activation, and calibration. And obviously, how to communicate about them. And this is very important. And then I will not touch upon the ex post evaluation now, in the interest of time. So 2 study cases are taken from a Committee on Global Financial System report to which I participated last year. And it was obviously not dedicated to real estate, but real estate case studies were part of this report. And I want to focus here on 2 case studies, one in the Netherlands, LTV caps, and another one in Singapore. In the Netherlands, and I know that there are some Dutch colleagues here in the room, so they may want to complement what I'm going to say, but in a nutshell, they had a risk assessment of a very high household debt combined with relatively low collateralization, so in other words, negative equity. Then in 2012, they decided to introduce an LTV cap set at 106%, which was rather high, and decrease it very regularly and very steadily so that it reaches 100% in 2018, so next year. And the objective was the primary objective was enhance resilience of households and lenders, so banks and households. So there was a very gradual tightening, 1 percentage point per year. And the question was, after 2018, do we further lower the LTV cap? So there has been a lot of modeling about to what level to calibrate this LTV cap, and it was decided so that it was shown by the DNB, the Dutch Central Bank, that a further tightening of 90% was desirable. And this was an assessment published by the DNB, so the communication was publication of the assessment, details about how the assessment was made, press release, etc., plus the recommendation to further tighten. In the case of Singapore, so the risk assessment was the following. They observed uneven practices by lenders when calculating DSTI ratios. There was also at the same time rising household debt and a strong growth of housing loans. So in 2013, they introduced a unified way to calculate DSTI called Total Debt Servicing Ratio. And this TDSR was on all outstanding debt obligations. Property, obviously, but also non-property. Here again, the objective was to increase the resilience of borrowers and lenders. Nothing about prices, or at least nothing explicitly about prices. So as regards the activation, as it was like in the previous case, a structural tool, it was not really the case of the timing. It was not such a big issue. And so it was introduced to complement other existing tools such as LTV caps, and also there was a limit in the maturity. And the calibration, so this TDSR, a threshold was set at 60%. Plus, they specified quite in detail the way they wanted this TDSR to be calculated. So how do we calculate the debt, how do we calculate the income, etc. The last study case that I want to talk about is commercial real estate in France. So I think Francesco said something about it previously, so I hope this will give him a few details about what has been done. So we had concerns in 2016 about the situation in commercial real estate market in France. So they were, to put it very simply, a buoyant market with a very strong demand, a lot of transactions, etc. Obviously, in the low interest rate environment, this was and the search for yield, so the commercial real estate assets were perceived as safe investments. And what was a little bit less reassuring for us, what has a very high price increase in the commercial real estate, but at the same time combined with a low profitability and profitability that was that eroded over the time. So this combination of positive trend for prices and drop in rental yields was for us a kind of contradiction, and it was not observed in other countries. So here you can have a look at the various segments that we have for commercial real estate in France, and the prices on the left-hand side and the rental yields on the right-hand side. And you can see that in particular segments such as offices were a problem for us. So we focused on this, not only because the price evolution of offices was worrisome, but also because it was this sector, so offices represented 60% of total investment. So it was the main sector in terms of investment, and also in terms of stocks. And here, this is where it's very interesting to see that things have to be very local when you look at also a sub-segment such as offices. Because when you look at the various areas, you have that in what is called Paris Quartier Central des Affaires, which means Paris Central Business District. You have very, very high prices and rising up over 12,000 euros per square meter. And in other parts of the country, you have sometimes less than 2,000, so 1/6. And for the rental yields, obviously, you see this very low rental yields for this Paris QCA. So an action plan was decided by the Macroprudential Authority, which is called the HCSF, So it decided to publish its diagnosis for consultation. Then we had several meetings with the professionals, and also we decided to conduct stress tests. The exposure here were quite limited. So as you can see, French banks are exposed to 166 billion euros, which is 2.5% of their assets. Insurers, a little bit more than 80 billion euros. And the real estate open-ended funds represented less than 4% of the total assets values owned by French funds. So 3 scenarios of immediate decrease in commercial real estate prices were decided. I'm not going to enter into the detail, but more or less it was to cancel what was assessed as an overvaluation. Stress tests, bottom-up stress tests were conducted. So for banks, insurers, and funds. And there were also additional hypotheses for funds and also for insurance, which are not mentioned in the slides, but this is not the main point of my presentation. So the results were the following. As regards French banks, so the average impact of the most severe scenario, and in their case it was scenario 1, was 2 to 3 basis points of their CET1 over risk-weighted assets, so very limited. For French insurers, there was one institution that had a small shortage of capital, meaning the coverage of its solvency capital requirement a little bit less than 100%. And for French funds, so the 3 scenarios with the outflow hypothesis did not affect their capacity to respond to the simulated outflows. So in this case, no risk of a systemic nature was assessed. So in this case, no binding macroprudential measures were considered necessary. But what was done was to adopt non-binding measures, so soft measures. First of all, measures of communication, so publication of the diagnosis, of the stress test results, obviously. Also, joint communiques about and statements about the question of commercializing real estate products to retail customers, and also another one about methods for real estate assets. There was also strengthening the monitoring with biannual meetings with market participants, promotion of academic research on these topics, and last but not least, reflections on how to contain imbalances between residential and commercial real estate and how to try to widen the investment base of investors so that they can contain more residential real estate. So I'm done. So just to conclude, to say that in each of these study cases, I tried to follow this framework of risk assessment, policy action if necessary, and then how do we activate and calibrate the measures. Thank you for your attention.